11 stocks to watch this week. You guys, they all report earnings this week. I've got 8 dividend stocks to watch this week. I have $60,000 invested in 2 of these stocks. I'm going to sell out probably entirely of one of the stocks, and I'm going to sell half of my position of the other stock. I'll explain that in a second. And I also have 3 growth stocks to watch this week. So 3 fast growing tech stocks. I've got to be honest, I've told you this before. Although I am primarily an income investor, that is my ends, a part of the means to my ends is to invest in growth opportunities and when they come along. And these stocks are exciting growth opportunities right now. 2 of them are potential buys right now. They have the potential to double over the next few years. One of them, I'm actually going to be buying this week. So I'm going to invest $5,000 in this stock this week. Stick around and I'll explain a little bit about my strategy there. Before we get to that though, we've got 8 dividend stocks that I'm watching this week, and one of these stocks is on the verge of a buy signal. I'm going to show you how to capture a safe 8% yield from this stock. I'm going to show you how to collect $360 in cash from this stock in just a matter of seconds. And I'm going to introduce you to one of my favorite buy signals that I'm watching for with this stock. Anyone who followed this buy signal in the past has had an opportunity to generate a 270% total return from the stock in a few years. We're about to get this same buy signal this week. I'm going to tell you about all of this just ahead. No more talk. I'm going to put my clipboard down for a second. Let's go ahead and get started. All right, guys, the first stock we've got up is Genuine Parts, ticker GPC. GPC should look familiar to you guys if you've been with us for a while. This was one of the very first stocks that Jason covered on this channel. Back in May, he did an in-depth analysis of GPC. He came to the conclusion that the stock was valued at $91.75 at the time. The company reports earnings before the market opens this Wednesday, February 17th. So considering its current price and what Jason had pegged its fair value at, it is about 9.8% overvalued. This is the perfect illustration of why we want to buy these stocks when they are undervalued. So for a couple of reasons. 1, margin of safety. So back then, when Jason covered this stock, it was trading for $76.44 or so. And at that time, he thought it was about 16.7% undervalued. And that's basically the margin of safety that we had. So that's the difference between where the stock was trading back then, that $76 or so, and what the price is that he thought it was worth at the time, which is $91.75. So 1, at the time, we could have bought in with a nice margin of safety. The second reason we want to buy these stocks when they're undervalued is because they offer a higher yield, which over the long term, it pays you more income. And I'll show you how that works in just a second. The higher yield would be at the time, at the $76.44 share price, the stock was yielding 4.4%. So that's the initial yield or the entry yield that we could have locked in. Maybe you did. Anybody that followed along with this suggestion after the video came out could have locked in a 4.4% yield on this. So today, the stock is trading around $100. And so comparing it to the fair value price that Jason came up with, it's now not a 16.7 or whatever that was percent discount. It's now a 9.8% premium. So now it's overvalued. So we really lost any kind of margin of safety that we had if we're just trying to go out and buy this stock today compared to where it was trading before. The other thing that we're missing out on is income. So at current prices, the stock is paying a 3.1% dividend yield. And so if we buy the shares today compared to back then, not only did we lose our margin of safety, but we also lost income because, like I said, we could have locked in a 4.4% dividend yield. Now it's 3.1%. That 4.4% dividend yield translates into 42% more income. This is why we are trying to stress over and over and over again that when you are buying these stocks, it is ideal to buy them when they appear undervalued because A, you get a bigger margin of safety, which translates ultimately into more potential capital gains, but B, you lock in more income, you lock in a higher yield. So it's 9.8% overvalued. Why are we watching this stock? Well, just in case it makes a big move to the downside after it comes out with earnings. I don't know if it's gonna pull back to fair value territory. I don't know if it would pull back to $91, but we may be able to get an idea for how much it could move based on its historical moves after it reports earnings. So what we're able to look at right here is how Genuine Parts has reacted after earnings in recent history. And we can see that the last time it reported, this column right here is what the price was one day before earnings. This column right here is one day after earnings. And then this column, of course, is the percentage change between the two. And so this is the column we want to look at, and we want to see how volatile has this stock been after reporting earnings. So it really hasn't done much. Back in 2019, it had some bigger pullbacks, so 6%, 6%. Back in 2018, it jumped 6%. So to be realistic, it would probably have to have a pretty bad quarter in order for the stock to pull back enough from its current level to fall back into that fair value territory around the $91. But it is earnings, anything can happen, and that's why this stock is on my watch list for this week. All right, guys, the next stock we're watching this week is Albemarle, ticker ALB. Albemarle reports earnings before market opens Wednesday, February 17th. I just had to go to the company's website and watch the beginning of a video presentation and listen to how the woman pronounced the company's name because I had no idea how to pronounce this name. The stock looked familiar to me though. This was a previous pick by Jason on Daily Trade Alert for the Undervalued Dividend Growth Stock of the Week series before we launched the channel. So back in April of last year, Jason covered this one. And at the time, holy smoky, he pegged its fair value at $92.72 when the stock was around $61. And so at the time, it was trading at a 34% discount. It was yielding 2.6%. Let's go ahead and fast forward to today and see what's happened. Today, ALB, I already forgot how to say it, Albemarle, is up to $160. And so it is just insanely overvalued because of its huge run up. Its yield has also fallen. So its yield is now below 1%. I doubt this thing is going to move that much after earnings, but let's just see how it's done historically. And last quarter, it jumped 8% after earnings. So again, we're looking what the price was one day before earnings, one day after, and that difference was 8%. So it's a little more volatile than some of the other ones that we've looked at so far, but I think it's safe to say that it's not going to fall from $160 to $92 after earnings. Nevertheless, I wanted to show you this as another example of why you want to buy these stocks when they're undervalued, because they do also offer capital appreciation in addition to a higher yield. All right, the next stock to watch this week is Hormel Foods, ticker HRL. Hormel reports earnings before the market opens on Thursday, February 18th. I'm gonna say that the target buy price for this stock is $46.67, or the equivalent of a 2.1% yield. I'll show you why I say that in a second. From current prices, that would indicate that the stock needs to drop about 2.8%. So we are very close. So get ready to buy this stock if you're interested in this stock, because it looks very, very close to our buy target. If you're not familiar with Hormel, it's really a very good dividend growth stock. It's just got a lot of growth. Look at the way the dividend has grown. So every year for the past 20 years, on average, it's grown an average of 13% a year. For the past 5 years, it's kept up that pace. Last year, yeah, the rate slowed down a little bit, but it's still fast. So it grew 11%. It's grown its dividend every year for the past 54 years in a row. Simply Safe Dividends gives it a 99 out of 100, which is just the best score that I've seen on their rating system. And so I've never actually seen 100. So it's a safe dividend. It's a fast growing dividend. Let's see when is a good time to buy this stock. I drew a horizontal line. I am suggesting that this is a buy when its yield hits 2.1%. or above. So historically speaking, this is the 10-year chart. I drew a horizontal line at the 2.1% yield. It's a buy when it hits 2.1 or goes above. And so right here, you can see that would have been a buy signal. And a potential time to sell it would be when its yield falls below 1.2%. So back in 2016, the stock price had shot up so much, its yield went down to 1.2 and lower. If you got in at 2.1% yield, and if you got out when it dropped to 1.2, then you could have locked in a total return that includes dividends of 230%. Let's just say you're following this pattern. you're out of the trade, right? Because it yields, this is 2016, so you sold it. And then you get back in, you buy again when the yield goes back up to 2.1 or above. And so here is our buy signal. So the time you sold to the time you buy, the stock fell 28.8%. Now you're back in Hormel, so you bought the stock again. If you got in here at the last buy signal, and if you're holding it today, then you're up about 73.3%. And that's a total return, so that includes dividends. So this is why I'm saying, watch this stock. If you're interested in it, then we could get a buy signal very soon, if there's not already one by the time you watch this. All right, now how has Hormel historically reacted after earnings? And this is where it gets a little exciting. You know, the last quarter, the stock dropped 6%. And so if something similar happens this time, then we'll get our buy signal. The quarter before that dropped 3%. But then all before that, it was just a very, very boring, not much happening, which is, for the most part, that's good. But if you're looking to buy a stock, if you've got some cash, then you like earnings because it offers you potential buying opportunities when the stock pulls back so much. If you don't want to wait for a potential buy signal because it may never happen, then something that to me is a no-brainer trade would be to sell a put option on Hormel. So I am saying that the target buy price to get us that 2.1% yield is $46.67 per share. What you could do is you could sell a put option that has a strike price below that number. So below $46.67, the first strike price that we see is $45. So you could sell one put option that goes out to January 21st of 2022. So about 11 months from now, less than a year, for over $300. Let's just say we get the last price it went for, which is $360 or $3.60 per share. Options work in 100 share blocks. And so this would actually be $360 payment. So here's what could happen. You could get paid $360 today for the opportunity to buy Hormel at $45 per share, which means that you would be buying it for less than what its target buy price is. And what that works out to be is $3.60 out of $45 is an 8% yield in less than a year. If you end up annualizing this yield, that's actually 8.5%. You could basically boost the stock's yield. The stock's currently paying about 2%. You could boost its yield from 2% to 8.5% by selling a put option. And this is safer than just buying shares outright right now because you're getting paid to buy them at a discount to where it's trading right now. To show you what this actually looks like, look at this chart. So this is the stock's current dividend yield. If you just buy shares right now, you're gonna get paid 2% a year in dividends. But if you sell the put option, which had the $45 strike price, you would be getting an 8.5% annualized yield, which is 4.5 times more income than what everybody else gets when they just buy shares outright. And so that to me is a no-brainer way to play Hormel if you want high income and safety. And if you like that stock, only do this with a stock that you like. And why we are watching this stock is, like I said, it's reporting earnings Thursday before the market opens. All right, dividend growth stock number 4 that we are looking at today is Portland General Electric, ticker POR. Portland General Electric reports earnings before the market opens Friday, February 19th. Jason recently covered this one. He covered it at the end of August, it looks like. And at the time, he thought that its estimated fair value price was $41.26. At current prices, that means it's about 2.9% overvalued. So at the time he recommended it, or that he suggested it, it was trading at about $38.31. That was a 7.1% discount, and you could have locked in a 4.4% yield. Fast forward to today, and the stock is now a little bit overvalued. So it's about 2.9% overvalued. What you could do, if this is something that is interesting to you, you could wait and see what happens after earnings. If the stock pulls back enough to give you a meaningful discount, then you could go ahead and buy it. Here we can see how it has historically reacted after earnings, and last quarter, it didn't do anything. A couple quarters before that, it dropped about 4% and 4%. Honestly, who knows what's going to happen after earnings? I just want to emphasize, again, we're not trying to predict these things. We're not trying to say, I think it's going to jump after earnings, or I think it's going to fall after earnings, so let me make my move now based on that. I'm saying wait until after earnings. Wait until the stock makes its move, and if it falls and it falls to your buy zone, then buy it. If it goes up, well, you missed out on that one. The good news is there is almost always something in the market that looks like it's on sale. And every single week here on this channel, you're getting one high quality, undervalued dividend growth stock. So Jason is featuring a brand new stock every single week that looks like it's a good deal. So don't get bummed if you're waiting for this one to fall a little bit after earnings and it takes off and now it's not even a buying opportunity anymore, because there's always going to be another opportunity that comes along. And so just don't get bummed out over that. All right, guys, next stock to watch this week is Walmart, ticker WMT. Walmart reports earnings before market opens this coming Thursday, and I've got about $43,000 invested in this stock at current prices. So back in 2014, I bought 200 shares. 2015, I bought 100 shares. So in total, I invested a little over $20,000 into the stock. Since then, the stock has treated me very well. It is a little more than doubled. It's up 110% or so. The problem is, because the stock has done so well, and because my starting yield was relatively low, so the price went up, that means my yield came down. And so on my $43,000 or so, I'm only earning 1.5% per year right now with my Walmart shares. And so that translates to only $648 a year in dividend income off of a $43,000 investment. So I'm considering selling half of my shares. So I put in about $20,000. I'm going to sell about $20,000 worth and then reinvest those proceeds. So $20,000, I'm going to take $10,000, I'm going to reinvest it in high quality dividend growth stock that is yielding maybe 3% to 4%. And so I'm going to make up for that lost income. So I'm going to sell half of my shares. And so I'm going to basically pull my income down to $324 per year. But then I'm going to reinvest $10,000 of that into a stock that yields possibly 4%, which would actually improve my income. So, and it would leave me $10,000 left over to invest in a growth opportunity. And so I think by doing this, I'm going to give up some safety that Walmart offers, because this is I consider this a very stable source of income for me. I don't think the stock price is going to just keep going up, obviously, as the way that it has. I think it would be very difficult for the stock to double over the next few years from current levels. And so I'm hoping to maximize my income and to actually grow my portfolio a little more by taking $10,000 of the proceeds and putting it into some growth opportunities, which I will talk about either later in this video or another day. So here you can get a better idea for why I am willing to sell some of my shares of Walmart. I've just absolutely loved this stock, but it just doesn't have the growth potential in terms of the share price appreciation and the dividend growth that it once did, in my opinion. So it's a very, very safe dividend, but it's paying 1.5% right now, and it's not like that dividend is growing very fast, because I would take a 1.5% yield if the dividend was growing 15% a year. But the dividend is growing, it grew 2% last year, and you can just see it. They've increased their quarterly payout by a penny every year for the past several years. This is why I plan to sell some Walmart. I'm going to give up some stability, but in the process, I'm going to find something else to reinvest my money in that pays me more income, that's also safe. And at the same time, I'm going to take the other $10,000 and I'm going to reinvest it in something that I think just has quite a bit more spectacular growth potential. Next stock to watch this week is Southern Company, ticker symbol SO. Southern Company reports earnings before the market opens on Thursday, and this is on my watch list because this is one of Dave Van Knapp's dividend growth holdings in his real life dividend growth portfolio. If you're not familiar with that portfolio, I'll put a link in the description below. What's so neat about Dave's portfolio is it is now generating over 10% a year in income based on his original investment. So he had put in $50,000, and as of the last update, he's collecting $5,025 a year in dividends. So next stock to watch this week is another stock in Dave's dividend growth portfolio. This is Alliant Energy, ticker LNT. Alliant Energy reports earnings before the market opens on Thursday. So this is another stock to watch this week if you're a dividend growth investor. And I'll put a link to Dave's portfolio in the description below. So at some point you guys may see Dave here on this channel. He only lives like 20 minutes away from me, but because of everything that's going on, we actually can't really get together these days. I'm hoping that at some point I can help get Dave set up to be able to contribute his ideas to this channel as well. And then I think everybody will just benefit from that. Next stock to watch this week is Deere, as in John Deere, ticker DE. Deere reports earnings before the market opens on Thursday, February 18th. This is another stock that has done well for me, but I'm actually considering to sell it. So back in 2015 to early 2016, I invested a total of $4,159, and the stock is actually up 323% since then. So it's now worth over $17,500. But the problem is I'm earning 1% on this money. So because the stock price has gone up, its yield has come down. And so this is the same issue that I have with Walmart, only this is exaggerated a little more because the yield is even less. I do believe that I can find better opportunities to grow my money safely by taking some money out of Deere and putting it into a higher yielding stock, something that yields more than 1%. So I gotta say that I don't even consider this a dividend growth stock anymore, because that's why it's got a little asterisk, because it's kept its payout flat since 2019, February of 2019. So now we are 2 years later and it didn't raise its payout. The streak is over as far as I'm concerned. So here's what I'm thinking about doing with Deere. I'm thinking about selling all of my shares, and I'll just walk you through how this would work and why I would actually do it. But right now, this $17,600 is earning me $170, right? And so if I sell all of my shares, I'm going to be getting $17,609. I have to pay long-term capital gains taxes on my earnings, okay? So my earnings were actually $13,450. So I'm going to just say that I've got to pay 20% on that. So I'm going to have to pay, these are just ballpark figures, guys. I'm going to have to pay $26.90 in taxes. And so that would come out of the $17,609. So $17,609 minus $26.90. I'm going to have $15,000 to reinvest into something that pays me a safe and growing income of more than $170 per year, because that's what I'm getting now. So I'm trying to look for an opportunity that generates more income and that offers similar safety as Deere, but also something that has the potential to grow. And so what I could do, let's just call this $15,000 to make it easier. So what I could do is I could take half of this, so divide by 2, I could take $7,500 and invest that money into a stock that is safely yielding 3% and that is growing its dividend. So let's just say I find a stock that yields a safe 3%. Now I'm generating $225 a year, and that has the potential to grow because hopefully I'm investing in a stock that's growing its dividend. So I just raised my income from $170 a year to $225 a year. But I also now have another $7,500 to invest. So I'm then gonna take the other $7,500 and invest it in an attractive growth opportunity. And so I'm collecting, not only am I getting the same amount of income by selling this stock, I'm actually getting a little more income, and it has the potential to grow. But I also have basically another $7,500 to, I wanna say play with, but be responsible with, to invest in something that has more attractive growth opportunity. Just as a quick reminder, or if you're new to the channel, the first time you're hearing this, I do allocate a portion of my portfolio to investing in growth opportunities. And the reason is pretty simple. If there's an opportunity to grow my money faster and bigger, obviously with a little more risk, then I'm gonna do that. And the idea is that it will help me scale my portfolio. It'll help me balloon the size of my portfolio from that position. Once the stock hits my target return, then I'm gonna sell off shares, and I'm gonna take that money and I'm gonna reinvest it in an investment that actually produces an income for me. So growth does fit in my strategy. That's all I'm gonna talk about these stocks. And the first growth stock to watch this week is a company called RingCentral, ticker RNG. RingCentral reports earnings after market close on Tuesday, February 16th. Now, I follow a handful of analysts to get growth ideas. So in the growth investing space, over the years, I have come to respect the recommendations of a select few analysts out there, and Michael Robinson is one of them. Michael writes for Strategic Tech Investor. We share a lot of his ideas on Daily Trade Alert, and so I am constantly exposed to his ideas. I've been following him for years, and this is one of his picks. He flagged it in November. He thought it would double in the next 4 years. It's already up 45% in less than 3 months. However, because of that, because it's risen so fast compared to the total potential upside, this is a stock I'm watching. I'm just gonna leave this as a potential buy for now, and we'll see how it goes after earnings and maybe in the next couple quarters. But for now, this is definitely a stock that is on my radar. Growth stock number 2 to watch this week is a name that everybody should be familiar with by now, Shopify, ticker SHOP. Shopify reports earnings before the market opens on Wednesday, February 17th. If you had invested $10,000 in Shopify 5 years ago, it would be worth $729,000 today. So spectacular growth. It's already seen. However, Michael and a few other analysts that I follow in the growth space, so guys that are just dedicated to growth ideas, they think it's gonna climb further from here. So the most recent time that Michael has recommended this stock, as far as I know, was in mid-December. He predicted that it would double in less than 18 months. It's already up over 35% in 2 months, but it could have quite a bit of room to run from here. And so I am watching this stock this week. All right, and then growth stock number 3 to watch this week is Universal Display, ticker OLED. Again, this is another Michael Robinson pick. I'm not getting paid to promote this guy, I promise. Just to be clear, full disclosure, I'm not a growth specialist. And so I lean on people that I have come to trust over the years for their recommendations in the growth space. And that is why you're gonna hear me talk about other names when I talk about these growth ideas. So I'm gonna talk about Michael Robinson. I might talk about someone named Steve Sugarud. I might talk about Matt McCall. So over the years in my line of work, I just come across thousands and thousands and thousands of different investment ideas from different analysts. I'm not saying that just because, a pick from Michael Robinson, for example, has worked in the past, that it's gonna work going forward. Obviously, there are no guarantees in this stuff. I'm just saying that when it comes to something that I'm not specialized in, such as the growth area, I lean on the research of somebody else. And so in this case today, all 3 picks were from the same guy. Next week, they might not be. Universal Display, OLED, the company reports earnings after market close on Thursday. So Michael Robinson called this one out most recently at the end of January. He's predicting a safe double in less than 3 years. I'm gonna put links to his articles in the description below. You're gonna see how he comes up with that. This is a stock that I am going to be investing in. And so I'm gonna put $5,000 into this stock this week. My strategy is quite simple when it comes to building my position in these plays. I'm going to invest a total of $5,000. I'm gonna invest half of that before the company reports earnings. So $2,500 before the company reports earnings. And then I'm gonna invest $2,500 in the stock after the company reports earnings. And so that way, I'm kind of dollar cost averaging into the play. So if the stock takes off after earnings, well, at least I got half of my position in at the lower price. Likewise, if the stock falls after earnings, well, at least the $2,500 that I'm investing after it falls is buying me more shares. So that's what I'm doing this week. I'm gonna be putting $5,000 into OLED. This is gonna be a growth play for me. So that's it, guys. Those are the 3 stocks. Now, I do wanna give you a heads up on something. Up until now, the ideas that I've shared with you have been primarily focused on the income part. I've showed you how I invest in municipal bond funds for safe, high, tax-advantaged monthly income. If you haven't seen that video, I will put a link to that video in the description below. I've showed you how I sell cash-secured put options for relatively safe, high income. And if you'd like to learn more about that, I will put a link in the description below. I've showed you how I sell covered call options on high quality dividend growth stocks. I'll put a link in the description to one of my latest income trades that way. But what I haven't talked about too much are the growth investments that I'm making and growth opportunities. And this is something that I personally believe, I know people have different opinions on this, and that is fine. All I'm doing is trying to share with you what works for me, what doesn't work for me. Like I mentioned before, I'm on a journey to generate $30,000 a month in passive income by the year 2030. And so growth is going to have to play a role in that. And so a part of my strategy, and I've mentioned this before, is that I take a portion of my portfolio and I allocate it toward higher risk, but higher potential return investment ideas, with the idea that I can generate a larger total return in a shorter period of time. And then I would sell off the investment, take that money, and then reinvest that money into investments that pay income to help me reach my goal. And so one of the things that I'm hoping to do is to sprinkle in some of these growth opportunities because they are ultimately tied to my income objective. And if I'm finding out something that might also help you in your own journey, then that's great, and I wanna cover it here. And so with all of that in mind, I'm hoping to maybe even get somebody on here that has found success in a certain area, that knows a lot more than me and can talk a lot more about how to take advantage of the area. Cryptocurrency, for example. Although I don't think that an asset like that should play a significant role in an income investor's portfolio, even allocating a portion to an idea that has high growth potential like Bitcoin could end up helping us to ultimately grow our income portfolios faster. And just to share a success story with you on how this growth to income model can work, I'm gonna try to get somebody on here named Tyler Ward, who has just found tremendous success by using cryptocurrency. So he invested in crypto. His portfolio just totally blew up, like in a good way. So he made a ton of money off of it. And then he sold some of his holdings. He took that money and he invested in rental properties. And so now he's able to generate an income from what started off as a growth idea. So that's why I think growth is so important. I think a story like Tyler's needs to be shared. I'd like to pick his brain a little bit. So we're gonna try to talk to him, but it's not just crypto, you guys. It's other growth opportunities where you may not be looking. That's what we wanna talk about. That's what we wanna bring you guys. And so hopefully all of this is coming up. Thank you guys for watching today's video. If you got anything out of it, please give this video a thumbs up. If you're not already subscribed to the channel, please consider subscribing. If you want to get a notification or an alert the next time that one of us on the channel posts a new video to the channel, then be sure to tap or click the notification bell and YouTube should let you know. All right, that's all I've got for today, guys. Hope you have a great rest of the week.